All right. Well, tonight's class is talking about capital budgeting. And I just want to give us some perspective in terms of where we are in talking about budgets. So I'll back up to kind of when we began with budgeting. We were looking at the master budget, and we were looking at the company as a whole and creating budgets for the entire year, for the entire company. And then we took a step back and we looked at individual budgets for departments, and that was part of the flexible budgeting. And then we, something popped up on my screen here. Okay, so we looked at the individual departments as part of flexible budgeting. And then we took a look at doing budgeting for one specific product and figuring out how much it costs to make one unit, or how much should it cost to make one unit of our product. And that was the standard costing that we did in the previous week. And so today, as we talk about capital budgeting, this is really long-term planning, meaning we're going to be looking at should we make an investment in something that might take years before we actually see it being profitable for us, okay? So there's a lot of guesswork that's going to go on in this area, and we'll see how it works. But the planning is not just for 1 year or 1 month. It's not even for 2 years or 3 years. The planning time horizon can be be from 5 years to 12 years to 20 years. But companies do this on a regular basis. And really, just the word capital in capital budgeting is referring to making an investment in something, in an asset, or making an investment in something the company is going to treat as an asset and see the rewards of it in the future. Okay, so I'm going to be sharing my screen with you. Let's turn to page 464 in our workbooks. Okay, so here we go. Page 464, capital budgeting. Let's in fact turn to page 465. 465. And at the top of page 465, I'd like for you to write cash payback. Write the words cash payback at the top of page 465. Okay, cash payback. Now what we're going to do in terms of capital budgeting here, I'm going to introduce the different methods or different tools that can be used to do this capital budgeting or long-term planning, okay? So I'm going to be introducing different tools. So the first tool is called the cash payback technique. And we've got our company here. It says Elijah Repairs Incorporated is considering purchasing an all-in-one repair machine. Okay, so that's what they're going to invest in, this all-in-one repair machine. And it says the following information was collected. We have an initial cost of $150,000, so that's going to be the dollar amount of the investment. This machine has a useful life of 12 years. It has 0 salvage value, so at the end of 12 years, the company doesn't think it's going to be worth anything. And it says the estimated cash inflows are $400,000, and the estimated cash outflows are $360,000. What I'd like for you to do here is underline cash inflows and cash outflows. Just underline those words, cash inflows, cash outflows. That's very important. This particular technique, the cash payback technique, uses cash flow. So it's cash inflows minus the cash outflows. So the first question here that we have on the page is, what is the net annual cash flow? The net annual cash flow. So we're simply going to take the estimated cash inflows and subtract the estimated cash outflows. And this will give us net cash flow of $40,000. Okay. Now, what questions do you have on this? No questions. Okay. All right, well, let's look at number 2. And so number 2, the formula is, what is the formula to compute the cash payback period? So we need a formula here. We're going to use this formula, so you want to make note of it, but what is the formula to compute the cash payback period? And the formula is as follows. We take the initial cost, and we're going to divide by the net annual cash flow. So in this case, the initial cost is it's also the investment that we need to make up front, but we're going to divide that by the net annual cash flow. Okay. All right. So number 3, see if you can do this yourself. Look at number 3 here. Based on the formula we just gave you in number 2, what is the cash payback period for the all-in-one repair machine? Let's calculate that. I'll give you a couple minutes with that. All right. So you should have taken $150,000 and divided by $40,000 per year, and that will give us a cash payback period of 3.75 years. Okay. Now what this means is simply that if we make this investment of $150,000 in this machine, it's going to take us 3.75 years, so a little less than 4 years, to actually recoup the amount of cash that we put into the investment. All right, so 3.75 years. Now, the lower the number of years or the lower the time period, the better. The lower the number of years or the lower the time period, the better. So what questions do you have on this before I go any further? No questions there, huh? Okay, well, let me see if I can complicate things a little bit. Turn in your workbook to look at page 478. Turn over to page 478. I don't have this on the screen, but I wanted to bring this to your attention. Page 478. Now, very similar situation here on page 478. What I wanted to draw your attention to is, there's a little fact pattern here. You can read that later. I want to draw your attention to the middle with the little charts there, talking about the red and the blue. And I want you to see that I have an initial cost, a useful life, salvage value is none. It says estimated annual revenue, at least for the red, $350,000. The estimated annual expenses is $320,000. And I want to point out that in this question, I ultimately am asking you about the cash payback period. Okay, that's what I want to know about, the cash payback period. Now, you could not just initially go and calculate it right away, because if you see it says estimated annual revenue and estimated annual expenses. The cash payback technique does not use revenues and expenses. It does not use net income. It uses cash flow. All right, it uses cash flow. So I just wanted to bring this to your attention that you're going to have to translate, net income into a cash flow number. And the way you're going to do that is by adding back depreciation to the net income. You'll add back depreciation, and then that's going to convert net income into a cash flow. Now, I'm going to save this for later. We're going to do that towards the end of today's class, but I just want to call it to your attention. Whenever you see something talking about revenues and expenses, dealing with the cash payback technique, you're going to have to make some sort of an adjustment to convert it into a cash flow. So we'll come back to that. So let's turn back in our workbook to page 466. Let's go to page 466. And at the top of page 466, I'd like for you to write cash payback and then a little dash and write the word uneven. Cash payback dash uneven. In our previous example, we had cash flows that were even. So every year, the cash was the same at $40,000 per year. However, there's something we need to do if they are uneven, and most of the time your cash flows will be uneven. So let's just see what's going on here in this particular problem. It says Danielle TV Repairs Incorporated is considering purchasing an all-in-one repair machine. The company uses the straight line method of depreciation, and it says the following information was collected. So we have an initial cost. We have an initial cost of $150,000, a useful life of 6 years, no salvage value. So that means at the end of 6 years, all we can do is throw away the machine. And then it says the estimated net cash flow in year one is $10,000. So that's cash inflow minus cash outflow. That's the net cash flow. That's $10,000 in year one. The net cash flow in year two is 20. Then we have 50 in year three, 60 in year four. Year five, it drops off to 24,000. Year six, it's at 90,000. So what I want you to do first here is underline net cash flow. Underline net cash flow for each of those line items there. Very important. We are still using a cash payback technique, and the net cash flow is what we need in order to do this, use this particular tool or this technique. When a machine or a large investment is about to be made, somebody has to project what they think the cash flows are going to be each year. Usually it's someone in the finance department, but a lot of time is spent coming up with these numbers here that I've just kind of laid out for us, okay? So that's part of the job. If you're hired in the finance department, you might have to do a lot of research and begin forecasting what the cash flows will be every year. And you're going to be wrong. You're going to be completely wrong. But some sort of an analysis needs to be made before we project out, should we make this investment or not? And so we can look at, I guess, at Disneyland, when they were thinking about opening up Star Wars Land, somebody had to project out the cost of opening Star Wars Land, as well as how much they thought the cash flow of the company would increase as a result of opening up Star Wars Land. So, and that was a huge decision. So we'll see if it ever pays back for the Walt Disney Company. All right. Okay, so we're about to calculate the cash payback period, and I'm going to walk you through a series of steps to help us with this, okay? So the first thing we want to do is complete the chart at the bottom of page 466 here. So I just want to deal with the year column. Just in the year column, I'm going to put in 0. That'll be our starting point. And then I'm going to write in the years 1 through 6. You can do the same. Okay. So those are the years in question. And I've grayed out certain boxes here that we really don't need to be considered, taken into consideration. So this next column is the investment column. All right. So the investment that we need to make in year 0 is what?
150,000. 150,000.
Very good, very good. 150,000. All right. So that's our initial cost. Now, this next column over, it says net annual cash flow. That means how much cash flow is coming in for each of these years 1 through 6. Now, I want to do 1 year at a time. So the last column is cumulative net cash flow. So I'm going to walk you through these line items here, and you'll get the hang of it pretty quickly, I think. So for year 1, the net cash flow is going to be $10,000, and the cumulative cash flow starting at year 1 is $10,000. Okay. So now, what would the net cash flow be for year 2? And what would the cumulative cash flow be for year 2?
20,000 for net annual
and 30,000.
30,000 for cumulative.
Very good, very good. So in year 2, we're going to have $20,000 for the net cash flow that's given to us for year 2. The cumulative cash flow is $30,000, which simply is how much total net cash flow have we received up to that point. So it's really a combination of year 1 and year 2 together. Another way of looking at this is it's the prior year cumulative cash flow plus the new net cash flow. All right, so please take a moment, fill out years 3, 4, 5, and 6 on your own, and I'll confirm your reality. All right. So your year 3 should look a little bit like this, $50,000 and $80,000. Here's years 4 through 6. All right. So I'll just pause a moment while you take a look at that. And please ask me questions if you have any questions here. I want to make sure you know where each of these numbers came from. Okay. So any questions here, please? Any questions at all? All right. So let's now go through the questions on page 467. And the ultimate question is, what is the cash payback period, okay, in years? So let's take a peek at this now. And these questions that I'm about to ask you are going to lead to you knowing how to calculate the cash payback period when the cash flows are uneven, which is what we have in this situation. So the first question is, in which year will Danielle recoup its investment? What say you on this? What year will Danielle actually recoup their $150,000 investment? Talk to me.
Year 5.
Okay. So I hear you all saying year 5. So that is correct. It is after year 4 and before the end of year 5. After year 4 and before the end of year 5. Okay. So let me ask, does anyone have a question about how I've worded that?
Question here.
Talk to me.
Will that be just because the way that finance or accounting, you know, is that accounting verbiage and wording, or what is the reasoning for that?
Well, I could say they're going to recoup their investment in year 5, but I need you to understand that 5 years has not passed.
Okay.
So that's why I'm taking a moment to say they're going to recoup their investment in year 5. That is true. Absolutely true. It's inside of year 5, but 5 years will not have passed. Okay? So I'm trying to add a little bit of clarity. So I need to know how I'm doing with that. Is that clear?
Yes, it makes sense.
Okay.
Follow-up question.
Talk to me.
If year 5 cumulative net cash flow was 150 instead of 164, would you have worded it differently?
Probably not. Probably not.
Okay. Thank you.
Let's say it was 151,000 or 150,001 cent. I probably would still say after year 4, but before the end of year 5. But I see your point. If it was specifically 150,000, we could say they recoup their investment in 5 years. You know, at some point in 5 years, that would be fine to say that.
Technically, it's still after year 4, which I think is what, you know, I think.
Yeah. In order to get to our ultimate answer, I need you to understand that it's after year 4, in this case, but before the end of year 5. When I did not word it that way in prior years, students always got the answer wrong. So just trying to improve on the teaching at this point.
All right.
Okay.
Makes sense.
All right. Yeah. Now let's look at number 2. That's a good question. Look at number 2 for me. It says, what net cash flow is needed in this year, so inside of year 5, to fully recoup its investment? How much cash flow do we need to occur during year 5 so that the $150,000 will be fully recouped?
10,000.
Okay, I hear folks saying 10,000. I see in the chat room 10,000. All right, and that is correct. They need $10,000 more. At the end of year 4, they had already recouped $140,000. And so they need $10,000 more to fully get back the $150,000. Okay, so that's 10,000 there. Look at number 3. No, I'm sorry, this is number 3. Look at number 4, okay? Now this is a very important question. assuming the cash flows. Oh no, we didn't do number 3. Oh, I'm sorry. Let's jump back to number 3.
Number three. Number 3.
Okay, thank you. Let's look at number 3. What is the net annual cash flow in this year? So inside of year 5, what is the net annual cash flow? So 24,000. Very good. $24,000. That's exactly what we're looking for. So in question number 2, I'm trying to lead you somewhere here. In question number 2, I asked you what net cash flow was needed in that year to fully recoup the investment. That was $10,000. And now in question 3, I'm asking you, what is the net annual cash flow that occurs inside of this year, in year 5? And the answer is 24,000. We see that just from our chart. Now we can move to question number 4. And question 4 really it has a lot of information in there. Let's see what question 4 is. It says, assuming the cash flows are evenly spread out throughout the year, what is the fraction of the year that's required for the cash flow to occur? Now, let me back up here. When it says assuming the cash flows are evenly spread out throughout the year, that's the assumption we have to make. We need to assume that the cash flow, that $24,000 that we're expecting to occur inside of year 5, we have to make the assumption that that cash flow is going to occur evenly throughout the year. That's very important. Now, if it's not going to occur evenly throughout the year, we need to spend a lot more time calculating at what points and times will that $24,000 come in to the company during year 5. Questions?
512.
No. I'm not on the answer. We're talking about just the fact that you need to make this assumption. When you're talking about the cash payback period, even when we were looking at page 465, with Elijah Repairs Company, when we're looking at page 465, Elijah Repairs Incorporated, we really needed to make the assumption that the cash flow occurred evenly throughout the year, both in the cash inflow and the cash outflow, so that the net cash flow occurred evenly throughout the year. That's the assumption we have to make. And if we're not making that assumption, we cannot use that formula that I gave you on page 465, and certainly it would affect how we do page 466 as well. But let's go back to page 466, 467, and focus a little bit more here on number 4 again. So it says, assuming the cash flows are evenly spread throughout the year, what is the fraction of this year the required cash flow will occur? Now we're saying, at what point in time will the company get to that $10,000? That's what we're looking for.
That's May. May is 5/12.
All right. So you could say May, and you would be correct in this case, but you would not be correct in every situation. So I want to give it to you so that you're correct in every situation. Okay? But you are correct in this case. It would be during the month of May, but it just doesn't work all the time. So here's how I want you all to approach this. I'd like for you to take the $10,000 that we got from question number 2 and divide that by question number 3, the $24,000. This is going to give us a fraction of a year. In this case, I'm going to represent it as a decimal of 0.42. Okay, I'm going to give it as a decimal, 0.42. So a little bit less than halfway through the year is what we're calculating here. And technically this does occur in the month of May, but like I said, that's just for this particular problem. So let's see how we use this 0.42. So the 0.42 represents the fraction of the year in year 5 that it takes for the company to get the $10,000. So with that in mind, now that's important. With this in mind, we can move to question number 5. All right, we're just now starting question number 5. What is the cash payback period for Danielle's investment in the all-in-one repair machine? So it's saying, what is the cash payback period? If we go back to page 465, question number 3, what is the cash payback period? We're answering that same question here now, just on page 467, question number 5. Okay, what is the cash payback period? So we know from question number 1 when the cash payback will occur, somewhere inside of year 5. So my question is, in years, how long does it take for us to fully recoup this investment? I hear you saying 4.42 years, and I see in the chat room 4.42 years, and that is correct. The answer is 4.42 years. It takes a total of a full 4 years plus a little bit more. But notice it's not 5 years plus a little bit more. It's somewhere inside of 5 years. So a full 4 years and a little bit more, 0.42. All right, talk to me. What questions do you have on this? All right. I see people asking me, how did we get that number? So that number is a combination of question number 1 and question number 4. It's a full 4 years and a little bit more. The little bit more comes in question number 4, the 0.42. All right. Other questions? Talk to me, please.
I'm sorry, could I see the chart one more time for the cumulative net cash flow and the net annual cash flow?
Sure. I have to back up to it.
Sorry.
Here's the chart. So, I mean, just looking at this chart, we can see that in year 4, at the end of year 4, we recoup $140,000. So that's where it's a full 4 years and a little bit more. So the little bit more will be taken out of the $24,000 net cash flow in year 5.
Okay.
And so I'll walk you through how to calculate that a little bit more. Other questions, please, talk to me.
Question.
Yes.
So you're just recouping the full amount of the 150,000, right?
We're calculating how long will it take to recuperate the full 150,000.
Got it. Cool. Thank you.
Question.
Yes.
So for number 5, the formula you had given on the previous page wouldn't apply. Is that correct?
We cannot use the formula given on page 465. The formula on page 465 only works when the cash flows are even.
Thank you.
Have to, so when the cash flows are uneven, you need to lay out a chart as we've done right here that you see on the screen. You need to take the time to do that and then walk yourself through those 5 questions, particularly paying attention to question 1 and 4. Other questions, please.
Professor Bobo?
Yes.
So I understand the concept of question number 5. So how to figure out if it takes something like that in the exam? There is not any formula for that. So
No, there's no straight formula. It's a thought process that gets you to the final answer. And the thought process is the way I've laid it out here on page 467. This is not as easy as page 465. Now, I would say in the real world, you could use a fancy calculator to just get the answer. There is a way for you to type this all into a spreadsheet program, and the spreadsheet program has some built-in functions that would spit out the final payback period for you. So I should say that is another way of approaching this that often we do in the real world. We use a spreadsheet program and we just know what the built-in functionality is.
Question on that.
Yes.
Do you need to add a formula, or is it the sum, or how does it
Oh,
calculate?
in Excel?
Yes.
In Excel, they have different functions that are built into the program, and there is a payback function. And it simply asks you it walks you through and asks you, what are the cash flows?
Okay,
then,
so it's on functions.
Yeah, it just spits it out. It's one of the functions.
Thank you.
So Morgan?
Yes.
So you add up all those number 1 and number 5 before number 1 add to the period number 5, so totally 4.42.
So you would take year 4 and add to it the little bit more that occurred in year 5. So that would be 0.42. So your final answer is 4 years and a little bit more, or 4.42 years. Does that make sense?
Question, Professor.
Yes.
For number 4, I still don't get why we have to divide the 10,000 from the 24,000.
You're saying you don't understand why I gave it that you should take 10,000 divided by 24,000?
Yes.
Oh, okay. Well, this is just a learning point. So I'm telling you, this is the way you do it. If your cash flows are spread out evenly in year 5, which is our assumption, the way to find out what fraction of a year that you would actually get that $10,000, because see, in year 5, you're getting $24,000 in total for net cash flow. So we need to ask, at what point during the year would you get 10,000 of it back? And the way you find that out is by taking 10,000 and dividing by $24,000.
Okay, thank you. Now I get it.
Question.
Yes.
If you get number 1 wrong, you're eventually going to get the rest of them wrong. Is that a correct assumption?
Well, in order to answer the ultimate question, you've really just got to think this through logically. So if you start off by thinking in an incorrect manner, yes, you are going to get the wrong answer at the end. Other questions, please.
Professor Morgan?
Yes.
Could you please explain again number 2, question number 2, where that 10,000 came from?
Okay, so in question number 2, what net cash flow is needed in year 5 to fully recoup the investment? Look in the chart. Okay, in the chart, year 4, we have a cumulative net cash flow of $140,000. Now, our initial investment or our initial cost was $150,000. So we need 10,000 more. So let me look at year 5. In year 5, the cumulative net cash flow is $164,000. We only need to get to $150,000. So we could say that we could back up to year 4 and say that $140,000 is where we end off in year 4. We need 10,000 more in order to fully recoup our $150,000. So the answer for number 2 is 10,000, which is just how much more is needed beyond the $140,000 to recoup the investment of $150,000. How's that?
Thank you.
All right, let's take a look at, all right, well, we need to take this up a level, okay? So I want to just start off by saying that was the easy stuff. All right, that was the easy stuff. The cash payback period is the easy stuff. So we're going to take it up a level now. We're going to jump into our next area here. So let me go to where we left off. All right, so look at page 468. Page 468, I want you, at the top of this page, write net present value. At the top of page 468, write net present value. That is the new technique that I'm about to discuss with you. Net present value. Now, my hope is that this terminology is not new to you, which is why I give you those reading assignments ahead of time. I want you to come to class confused, but I don't want you to come to class not knowing what I'm talking about at all. So I'd rather you be confused versus not know anything. All right, so I'm hoping net present value, you're a little bit familiar with that phrase, but let's walk through this together. Page 468. Do I have a question?
No, that's NPV, right? NPV.
NPV. That is the abbreviation. NPV, net present value, NPV, one and the same. All right, page 468. It says, Shama Repairs Incorporated is considering purchasing an all-in-one repair machine. The company uses the straight line method of depreciation, and the following information was collected. So again, we have the initial cost of $150,000. We have the useful life of 12 years, 0 salvage value. So at the end of the life of this piece of machinery, it's not going to be worth anything. We'll pretty much just throw it away. And then it says required rate of return, 5%. Annual cash inflow, $400,000, and the estimated annual cash outflow, $360,000. Again, I want you to underline cash inflows and cash outflows. Underline that. This net present value technique uses cash flow. It uses cash flow. It does not use net income or revenues minus expenses. It uses cash flow. That's a good test question. All right. So let's walk through these 4 questions to see if we can't compute net present value, and then we'll interpret what the net present value is telling us. So question number 1, what is the net annual cash flow? Take a moment, please calculate that on your own based on what we've already talked about. Okay, so the net annual cash flow is simply going to be the $400,000 cash inflows minus the $360,000 in cash outflows, giving us a net cash flow of $40,000 every year. Let me pause there. What questions do you have on that?
Professor?
Yes.
What about the depreciation? Is the depreciation considered in this process?
In this particular question, it does not, we don't need to take into consideration depreciation. So that's additional information that you don't have to use. Now, when you do need to use the depreciation information, if you're given net income or revenues minus expenses, then you'll need to calculate depreciation to add back to net income in order to convert net income into a cash flow number. And we're going to take a look at just how we do that towards the end of the class today, because that'll be very important on how we do it. And I want you to know how to do it. So we're going to take a look at that together. Look at question number 2. Question number 2 asks us, what is the present value of the future cash flow? This net present value technique uses the time value of money concept. The time value of money concept. So if you were with me for financial accounting, or you took a look at the extra credit that we had using the time value of money, you'll understand this concept already. But we need to calculate the present value of the future cash flow. Now, this can be done with a fancy calculator. However, because I have you all using a simple 4-function calculator, we're going to use time value of money tables that are located at the end of your workbook. So look at workbook pages 500 and 501. Look at workbook pages 500 and 501. Many of you did that extra credit assignment, so you should be familiar with these tables here. And so we're going to use these tables in order to calculate the present value of the future cash flow. All right, so keep your finger there on page 500 and 501. And then look back at page 468. In question number 1, we calculated the net annual cash flow to be $40,000. So now we want to find out, what is the present value of that future cash flow? I like to put together a chart so I can visualize this. So I'm going to put a timeline together here. And I'm going to go from period 0 all the way to 12 periods. And just to demonstrate how this cash flow is occurring, it's saying that we're going to get $40,000 every year repetitiously for 12 years. And the question is, what are all of these payments, or this cash flow of $40,000 each year, what is all of that worth today at time 0? That's what it's asking us. So if we flip over to workbook page 500 and 501, on page 500, we have the present value of 1 table. And on page 501, we have the present value of an annuity of 1 table. Which of these tables should we use?
Annuity.
Value annuity of 1.
All right, all right. I see a lot of people jumping in there, even in the chat room. We need the present value of an annuity table. Okay, so let's put that up here on our chart. We're going to use the present value of an annuity of 1 table, and we need to look up a certain number of periods and a certain interest rate or rate of return, and that will be as follows here: 12 periods and 5%. All right, our problem, we're getting paid $40,000 every year for 12 years. That's going to be the cash flow. And our problem said that the required rate of return is 5%. So that's what we're going to use, 5%. So we're going to look that up in the table, the present value of an annuity of 1 table. I'll say that again, the present value of an annuity of 1 table. We should find the factor 8.86325. All right. So make sure you can find that factor. And next, we're going to multiply that factor of 8.86325. We're going to multiply that times $40,000. So we should look up 12 periods, that's in the first column, and then go over to 5% across the top, find where the 12 periods and 5% match. That gives us the factor 8.86325. Let me pause there. Any questions there? Okay. So we're simply going to multiply the factor 8.86325 times our net annual cash flow of $40,000. And that's going to give us $354,530. We're saying that the present value of the future cash flow is $354,530. So that is question number 2 on page 468. Talk to me. What questions do you have on that? I don't want to move forward if you have a question on that.
What does that exactly mean?
That means, well, what that's saying is $40,000 received every year for the next 12 years. All of that is worth $354,530 today, right now. That's what that's saying. And the whole concept there is the time value of money concept. So that's what it's worth today. All right. So the key here is to use the right table and pick up on the right numbers. Okay. All right. So let's go back to page 468 in our workbook. Let's go to question number 3. Question number 3 is, what is the net present value of the all-in-one repair machine? Now at the top of this page, you wrote net present value. So question number 3 is really answering the question of what is that net present value? So the way we calculate the net present value is we simply take the present value of the future cash flows that we just calculated in number 2, and we're going to subtract the initial investment or the initial cost of $150,000 in this case, and that equals a net present value or NPV of $204,530. Questions on that, please? So again, to calculate the net present value, we take the present value of the future cash flow and subtract the initial cost or subtract the initial investment. Okay. Now, look at question 4 there. Should the company make the investment? Should the company make the investment?
Yes.
Yeah.
All right. I hear you saying yes. But the question, you can't just walk into your boss's office and say, you know, I've spent all week figuring this out, and yes, we should make the investment, and then turn around and walk away. You have to say why.
A positive number.
No, that is not the answer. It's not because the number is positive. It is not yes because it's so much money, I see in the chat room. So now this is the learning point here, okay? This is the learning point. So in your reading, you may have missed this. That's why I'm talking about it right now. The decision-making point when using this tool, the net present value technique, if the net present value is 0 or greater, make the investment. So we could have calculated the net present value to be 0. That means we should make the investment. Okay, so if the net present value is 0 or more, make the investment every single time. 0 or more. Okay, so the answer can be 0, and you're still going to make this investment. Questions on this, please? And someone did say because the number is positive, and I won't go into the mathematics of it all, so I'll agree with that now. Yes, if the number is positive, go with it. I don't recall in my math classes if 0 is a positive number. I don't know if that's considered to be a positive number. I'm sure someone will, if I came out and said it's not a positive number, somebody will look it up and tell me I'm wrong. So I just don't remember. But I know that the answer to this question is, as long as the net present value is 0 or more, then we can make the investment. Okay. So if 0 is not a positive number, I think I've covered myself. All right. So somebody look it up. Is 0 a positive number? And tell me by the end of class. All right. Because you guys are very smart. Or if you just remember from your math class, you just tell me. Okay. I'm not a mathematician. All right, we're back from our break and had a couple questions here. Let's see, Ray, would you mind asking your question again?
Yeah, no problem. So my question was, would the answer be to number 4, yes, because the net present value is $204,530, or is it just that it is more than 0, or 0 or more?
Yeah, I think this is page 468, number 4. I think the appropriate answer, should the company make the investment? The answer is yes, the company should make the investment because the net present value is 0 or more. Okay, cool. 0 or greater. I think that would be the appropriate response. And you know, if your boss asks you, well, what is the or more? We're going to talk about that in a little while. We have a couple more things to do before we get to it, but we'll talk about something along those lines. What does it mean when it's more? Okay.
Thank you.
Yep. All right. Any other questions? Just going for anything we've covered so far today. So from the beginning of this section up till this point. Any questions at all? Okay. So let's go to page 469, and I'll share my screen with you. Page 469. At the top of this page, let's write net present value, uneven cash flows. Net present value, uneven cash flows. In our prior example of doing net present value calculations, the cash flows were spread out evenly throughout the year, and those are always okay. But most likely, you're going to have some cash flows that are not spread out evenly. So I want you to be able to calculate the net present value when that occurs as well. So here on page 469, we've got Josiah TV Repairs Incorporated. They're considering purchasing an all-in-one repair machine. And it says here the company uses the straight line method of depreciation and requires an 8% rate of return. That's very important, 8% rate of return. And it says that the following information was collected. So we have the initial cost of $150,000. The useful life is 6 years. Salvage value is 0, so that means they're going to throw this machine away. And then we've got some estimated net cash flow numbers for years 1 through 6. So 10,000, 20, 50, 60, 24. and then 90. Okay, so those are the estimated net cash flows. Again, I'd like for you to underline cash flow for each of those years. Cash flow. It's very important. It's not net income, it is cash flow. This net present value technique uses cash flow numbers. Okay. All right. So the first thing we're going to want to do is to complete this chart here at the bottom of the page. So I'm just going to type in the years 0 through 6 on that first column, years. Okay. And then the second column here, net annual cash flow, we should just go ahead and write in what is the net annual cash flow for each of these years. Now I'm going to have for year 0, I want to write in a net cash flow here as well. And I'm going to make that a negative number. So I'm going to put in negative $150,000 for year 0. And then I write in the other cash flow numbers. All right. The next column is the discount factor column. Now I'm going to start off by saying in year 0, the discount factor is 1. All right. In year 0, the discount factor is 1, meaning year 0's dollar amounts will not be, they will not be factored into anything. It's just 1. Okay. And then I want to look at, I want to go back to our time value of money tables. I want to look at the table labeled present value of 1, which is found on page 500, present value of 1 table. And we're going to find discount factors for these other years. So our rate of return that's required is 8%. So in the present value of 1 table, I want you to find 8% at the top, and then link that up with 1 period. 8%, 1 period, you should find the factor 0.92593. And then we need to do a similar thing for year 2. In the 8% column, look for the corresponding factor to period number 3, and you should find, I'm sorry, to period number 2, and you should find 0.85734. And we'll do the same for period 3. The factor is 0.79383. Period 4 would be 0.73503. Period 5 would be 0.68058. And then period 4 is 0.63017. All right, talk to me. What questions do you have on those factors, that discount factors that I've just come up with? So everyone's good on where those came from, and we cannot use the annuity table just because we don't have an annuity or a repetitious dollar amount in this case. It just changes every year. So we have to use these factors. Okay. All right, so no questions there. So the next thing we want to do is calculate this discounted net cash flow area. Now, the way we do that, we're simply going to take the net annual cash flow, multiply it by the discount factor to get the discounted net cash flow. So I'll do that now. Here's what the numbers would look like. Take a moment, make sure you can calculate them as well. Any questions there? Talk to me. Okay, so I believe I've given you enough time to write that in. So now we're going to use this chart to help us answer the questions on page 470. So look at page 470. Question number 1, what is the present value of the future cash flows? What is the present value of the future cash flows? Now, the way we're going to do this is simply looking at this table, look at the discounted net cash flow area, and I want you simply to add up all the numbers in this column, leaving off that year 0. Leave off year 0, and we're going to add all these numbers together that I've highlighted here. And that equals $183,248.62. This is the present value of the future cash flows. Questions on this, please? So everybody's good on that. All right, the second question is, what is the second question? What is the net present value of the future cash flow? So this is really where we're calculating the net present value. We've already calculated the present value of the future cash flows. So the net present value, we really just need to subtract the initial investment. So again, we can look at this last column, the discounted net cash flow column, but this time incorporate in year 0, that minus $150,000. And if we do that, we get a net cash flow of $33,248.62. Again, we're really just taking our answer from number 1 and subtracting the $150,000. All right, so our net present value here is so simply subtracting the $150,000 from the present value of the future cash flow, giving us $33,248.62. So the big question is, should the company make the investment? Question number 3. What say you?
Yes.
Yes. Yes.
Now I'm paying you guys $150,000 a year. At $150,000 a year, you cannot walk into my office and say yes.
Because it's 0 or greater.
Complete sentences, please.
Yes, because $33,248,000 is more than 0. And if the present value is greater than 0, then do the investment.
Okay, you're fired. You didn't say that right.
Dang.
Somebody else. Come on, what's the answer for number 3? Complete sentences. Somebody talk to me.
Okay, let me try.
Go for it.
Okay. Yes, because $33,248.62. The present value is 0 or greater.
Not quite.
Not quite. Something like that.
Basically, you walked into my office and said, yes, because 33,000 is greater than 0.
Can we just say yes because there's a positive net present value?
No.
It's 0 or more.
There you go. So in a complete sentence, we could say that the answer is yes, the company should make the investment because the net present value of the investment is 0
or greater.
Or greater.
Question here.
Yes.
So what is the rationale between the 0 being a valued investment?
So when it's 0, if the answer was 0, if the net present value was 0, it's telling us that the investment earns an 8% rate of return, which is what we require. It says the required rate of return is 8%. So if the answer is 0, the net present value is 0, it's saying that this investment gives you exactly an 8% rate of return. And that's why you'd make the investment.
Professor?
Yes.
So it means that 0 means in even point. The company is in the even point?
No, I don't want to say break-even point. It's just that their requirements are being met. That's different than a break-even point. We're not saying they're getting back all their cash at this point or anything like that. We're not talking about breaking even. We're just talking about earning a rate of return on their investment of $150,000 that they wanted. So that 8% is all they wanted. So if the rate of return was 0, if the net present value was 0, that means that this investment earns exactly an 8% rate of return. That's what the 0 would indicate. Other questions, please.
Question.
So, Professor, what is the right answer for 3?
What is the right answer? The answer is yes.
Yes.
Because the net present value of this investment is 0 or greater.
Question on that one, Professor?
Yes.
So if it's 0 and that's 8%, it's making that rate of return. Not that you would say it in the answer, but in this case, it would be more than 8%. Is that correct?
It is earning more than 8%.
Okay, cool.
That is correct. Yeah, we're going to still get to that. We've got to learn that concept as well, too. So hang on. All right. Let's look at a new one here. Flip over to page 472. Flip over to page 472. Let's look at this. Top of page 472, I want you to write net present value and profitability index. Net present value and profitability index. So we've already learned about net present value. We've learned about that particular tool. So we're going to pick up on that and learn about profitability index as a new tool. So let's just start with recapping what this problem says. It says here that Jarrett Productions, a movie studio, is considering purchasing a new video camera. It has narrowed down its choices to 2 cameras, the red one and the blue one. Each camera can perform different capture techniques that moviegoers find fascinating. There's a limited amount of funds and only 1 camera can be selected. It says Jarrett needs your assistance selecting the best camera. So let's unpack this paragraph here. It says there's a limited amount of funds. Underline limited amount of funds. That's important. Underline limited amount of funds. Okay. Now it says the following data has been captured for each camera. The initial cost is for the red and blue, $40,000 and $90,000. And then it says the present value of the future cash flows is $50,000 and $110,000, respectively. I'd like for you to answer question number 1. Take a moment, answer question number 1 for both the red camera and the blue camera. So you're gonna have two answers, one for the red, one for the blue. Answer question number 1. And just pause. Okay, that should have been enough time. All right, now I'm gonna use, if you look at the next page over 473, it says complete the summary chart for Jarrett. I'm just gonna be putting my answers into the summary chart here. So question number 1 was, what is the net present value of each camera? You should have come up with the following. The red camera is $10,000 and the blue camera's net present value is $20,000. So you are already presented with the present value of the future cash flows. You only needed to subtract the initial cost. Questions on this, please? Okay, so no questions there, huh? All right, let's move on. Question number 2 on page 472. What is the formula for the profitability index? So I'm introducing this new concept now, the profitability index. The formula is the present value of the future cash flows divided by the initial investment. The present value of the future cash flows divided by the initial investment. That is the formula we want to use. Now, this profitability index is a new tool. It helps us to decide between investments that are similar, in nature, but when there's a different investment amount, we need to use the profitability index to help us decide which investment is the best one to go with, particularly when there are limited funds available, meaning we can't buy both the red camera and the blue camera. So which one should we make the investment in? That's the question we're trying to answer. This profitability index helps us to answer that question. So look at question number 3 and calculate the profitability index for each camera. Take a moment, calculate the profitability index for each camera using this formula. Go out to at least 2 decimal places, minimum. Your final answer will be a decimal, not a percentage, but a decimal. Okay, so you should have come up with the following profitability indexes. The red is 1.25 and the blue is 1.222222. Just kind of repeats itself. Going up to 2 decimals is most of the time sufficient. Any questions here just on the mathematics of the profitability index? So again, the formula for the profitability index is the present value of the future cash flows, excuse me, divided by the initial investment. And these are our final numbers for the profitability index, which I've put inside the chart at the top of page 473. Profitability index numbers. Okay. So we need to now figure out, look at question number 5 on page 473. Which camera should Jarrett purchase and why? Well, because we have limited funds and we cannot, because we have limited funds and we have different investment amounts, we need to look specifically at the profitability index to answer this question, which one should we purchase, okay? So because there are limited funds, we need to look to this profitability index. We can only buy 1 camera. We would select the red camera because the profitability index is the highest in this comparison. We would select the red camera because it has the higher profitability index. Questions on this, please? Questions, please. Any questions? Now, one question I'm typically asked is, what is an index? It's not a percentage. It's kind of like a rating scale. I guess if you were watching some sort of a competition, like a figure skating competition, and you were asked to rate how one figure skater was doing versus another, you would write on a piece of paper a number between 1 and 10, I guess. And some you might rate as an 8 or 7 or 5, but it's just the scale as such. It's not saying that they are a 10% better or 90%, or they did a 90% job or anything like that. It's more about just on a scale of 1 to 10, rate that figure skater. And the number you give them is an index. It's not saying it's the percentage or anything like that. You're just rating them on the scale of 1 to 10. So that's kind of what an index is in this case. All right, any other questions? Look at number 6 then on page 473. It says if Jarrett's funds were not limited, which camera should be purchased and why? So we're changing the fact pattern a little bit here. What do you all think? If the funds are not limited, which camera should be purchased?
Red.
Why?
Because initial cost is lower and the present value of future cash is lower than the blue and the higher profitability.
No.
Blue, because
based on what we've talked about today, which camera should be purchased? You said blue? Why?
Because your net present value is higher, so your dollar amount's higher.
No.
Lower investment.
Say which one?
Because the lower investment on the red.
Oh, so you're going back to red. Okay, that's not the answer. Anybody else? Based on what we've talked about today. All right. So look at the information that's being presented here. It's saying that the funds, it says if the funds are unlimited, meaning the company has enough money to make both investments, which one should they buy? And the answer is both. They should make the investment in both because the rule about the net present value says anytime your net present value is 0 or greater, make the investment. So in this case, they should invest in both, simply because the net present value of both is 0 or greater. I'll let that sink in. Okay, hope it sank in. All right, so again, the rule about net present value, make the investment every time if the net present value is 0 or greater. Now, if you don't have enough money to make the investment and you can only do one or the other, then you look to the profitability index to help you. Okay, so that's when the profitability index comes in. And that's that one. All right, any questions there, please?
Does the fact that they both have unique qualities matter? Like if the blue camera could do exactly the same thing as the red camera, would that matter for investment?
Well, I think in this case, I was just trying to differentiate between why you would want the red one versus a blue one. But I think the capabilities of different machinery, that is an important factor. I mean, in general, you know, the capabilities of a machine versus another machine, those should be considered. So if you found 2 separate machines that do the exact same thing, then if in fact they do the same thing, there's really nothing that differentiates them. So in this case, I just kind of put a blanket thing that they are different, but they both have a positive benefit for the company, even though their benefits are somewhat different. Okay.
So what you're saying is if they were both the same, choose the one with the higher index then at that point.
No.
Why would you need 2 of the same exact cameras?
No, they're not the exact same cameras.
And these are not.
Yeah, these are not.
But if they were both the same exact camera, although different maybe manufacturers, one was blue and one was red, although they were the same stuff goes on with them. They do the same thing. One was more of an investment and the other was less of an investment. When they have the same.
I think if they did the exact same thing, then their future cash flow would be the same. Is that a fair statement? If they did the exact same thing, their future cash flow would be the same. Their net present value then might be different. So I would say you just buy the cheaper camera.
Correct.
Yeah, just buy the cheaper camera. So if your only goal, if you had to decide between buying a red car or a blue car, and the only thing you needed the car to do is to get you from point A to point B, then, and they both get you from point A to point B, then just buy the cheapest car. Now, if you need to get from point A to point B and feel good about yourself, you know, whatever that means in your mind, then you might choose a red car versus a blue car because you get a warm, fuzzy feeling when you see red versus when you see blue. Then they're doing something different. Okay, so all these little nuances do come into it after a while. Yeah, so like, how do you really decide between which car to buy? There's a lot more than just, oh, both cars go forward and back. You know, there are other little intrinsic factors. All right, look at page 474, everybody. Page 474. Top of page 474, I want you to write internal rate of return. Write internal rate of return for ViewTube company here. So this is the next technique that I want to talk to you about, internal rate of return. Let's read here what it says. It says, ViewTube company is considering purchasing an enhanced processor to process online video faster. The cost of the enhanced processor is $641,766. For its investment, ViewTube expects to receive $100,000 in cash each year for the next 10 years. So it's telling us that the future cash flow is that for the next 10 years, this company will receive $100,000 every single year for the next 10 years. So in year one, they'll get 100,000, in year two, 100, year three, 100, just a repetitious dollar amount every year for the next 10 years. What I would like for you all to do, and I'll give you a little bit of time with this, please calculate the present value for this investment at 8%, 9%, and 10%. So numbers 1, 2, and 3 is what I want you to answer. So I'll give you a little bit of time there. Please calculate the answers to numbers 1, 2, and 3 based on what we've already covered tonight. You're calculating the net present value of the future cash flows. Or of all the cash flows, I should say. You're calculating the net present value. Take a moment with that. All right, let's see how you did. Well, let's see. Best way to approach this now. For number one at 8%, what did you all get for your net present value? Say it out loud or in the chat room, either way.
Got 6.71008.
6.71008? That doesn't sound right.
171,
No.
8.
I got $671,008.
Yeah.
See, some people saying 641,766. Some saying 541,766. 671,008. Let's see. All right, let's take a peek here. We're going to use the present value of an annuity of one table. So this is an annuity situation. All right, you're going to look up 10 periods, 8%. Find the factor 6.71008. You're going to multiply that times 100,000 and get 671,008. But that is not the answer to the question. The net present value requires us to subtract the initial investment of 641,766. Therefore, the net present value is $29,242. $29,242. All right. So that's the net present value based on what we've talked about today. Questions on that, please? All right. So at 9%, the net present value.
Zero.
Looking in the present value of annuity one table, you said 0? Okay. Let's just calculate it. See how we do here. I get 0 as the net present value at 9%. Okay. Questions on this? Somebody came up with negative 0.23. Yeah, that's saying you're not using, you're using some other tables or maybe a fancy calculator. We need to use the tables if you want to get my answers. Your answer is probably more precise. All right, so for number 3 at 10%, I have a negative net present value of 27,309. Take a peek. Let me know if you have any questions on this one. I have to start my video up again there. Okay, so, all right, so questions on 1, 2, or 3. Any questions? Talk to me. What questions do you have? One, 2, or 3. Okay, now we're talking about on this page, our learning point is the new tool called the internal rate of return. The internal rate of return is the rate of return that will make the net present value equal 0. That is the internal rate of return. Whatever the rate of return that will make the net present value equal to 0. So what is the, so question number 4, what is the internal rate of return?
9%.
9% is the answer. 9%. So I kind of took a different path here to get to this 9%. Usually what you have to do is kind of play guessing games at the rate of return to see which one will give you a 0 net present value, or one that will give you as close to 0 as possible. The table that we have in our workbook in the back there, those tables are not complete. You don't see several interest rates there. Several of them are not listed. So when you're calculating the internal rate of return in the real world, you should use a fancy calculator to do it. Or you could use some formulas that would take forever to do. But using tables isn't necessarily going to work for you, because the internal rate of return might be, instead of 9%, it quite possibly could be 5.6%. And the tables that you have in front of you may not have that level of information for you. So you might be finding, if you are using the tables, you may just use a rate that gets you close as possible to the net present value being 0. So again, the answer to number 4, what is the internal rate of return? The answer is 9%, because at 9%, the net present value is 0. Okay. Now, the when do you use the internal rate of return is the question I'd like to try to answer. When would you use it? Sometimes you don't know what the rate of return is on a particular project or on a particular project. You don't know what it is. So what you would do is simply calculate the internal rate of return to, find out what is that rate. So let's say that we did have this example here where the initial investment is this $641,000 number. And once we know what the initial investment is going to be, we've calculated what the future cash flows are going to be. We just don't know what the rate of return of this particular project is, or this investment is. So what we would do in that case is take the time to calculate the internal rate of return. In this case, we've calculated the internal rate of return to be 9%. Now, to decide if we're going to make the investment or not, we have to ask ourselves, is that 9% a sufficient rate of return for us? For example, if the company had a rate of return, a required rate of return of 10%, this particular investment only has a rate of return of 9%. So we would not make the investment. If the rate of return that we required was 8%, we would make this investment because this particular investment has a rate of return of 9%. And we only required 8. And this one gives us more than 8, so we would make the investment. All right, so that's my explanation of that. Talk to me. What questions do you have? I want to clear up your questions. Okay, so let me generate some questions for you now. Look at page 475. I'm not going to do this one, but I want you to tackle this one. Page 475, World of Papercraft Company is considering purchasing an enhanced processor to process online games faster. The cost of the enhanced processor is $729,196. For its investment, World of Papercraft expects to receive $112,316,000 each year for the next 12 years. And then you've got this question, what is the internal rate of return? Well, you just have to keep guessing at rates of return until you get to one that makes your net present value equal to 0. Now, you can use the tables for this one. I'm not going to do it right now, but you essentially are going to look up something in the present value of an annuity table. And when you look in the present value of an annuity table, you're going to be looking up different rates at 12 periods and seeing which one of those rates gives you a net present value equal to 0. And then after you figure that out, you can answer questions 2 and 3. But let's not do that right now, so don't say anything in the chat room about that either. That's going to be part of your homework assignment. All right, so I'll let you play with that. That one will be fun. You can use the tables on that, or if you have a fancy calculator, you can try that as well. But using the tables is the preferred method for this particular class. So just wanted to recap a little bit of what we've talked about so far today. Today we've looked at a few different tools to help us do some capital budgeting and figuring out if we want to make certain investments. So we looked at the cash payback technique. The shorter the cash payback period, the better the investment. Okay, the shorter the better. And you can just ask yourself, if you loaned your friend $100, when do you want that to be paid back to you? Do you want it paid back to you in 2 weeks or in 1 second? The shorter the better, right? The shorter the better. We looked at the net present value technique. The net present value technique said to that you should make the investment as long as the net present value was 0 or greater. We looked at the profitability index technique that said, if you are trying to decide between two different investments and you have limited amount of funds, meaning you don't have enough money to make all of the investments, choose the investment with the higher profitability index. And all of those techniques used cash flow, all right? All of those techniques used cash flow. I want to now go to our final technique here. Our final technique does not use cash flow. Look at page 476. I'm going to share my screen with you. Look at page 476. All right, page 476, it says Potterville Repairs Incorporated is considering purchasing a 4-in-1 repair machine. Oh, I'm sorry, at the top of page 476, let's write in annual rate of return. That's what we're going to be talking about here. Write in annual rate of return, top of page 476. Okay, so it says Potterville Repairs Incorporated is considering purchasing a 4-in-1 repair machine. The company uses the straight line method of depreciation, and the following information was collected. So we've got the initial cost, $260,000. We've got a useful life here of 10 years and a salvage value of $0. A required rate of return of 15%. Estimated annual revenue is $400,000. Estimated annual expenses is $360,000. Okay. So the first question is, what is the annual net income? What is the annual net income? Now this method, this annual rate of return, it does not use cash flow. It uses net income, so revenues minus expenses. So the annual net income here is going to be $40,000, which is simply revenue minus expenses, which is $400,000 minus $360,000, $40,000. In this case, this is the annual net income. Question 2. What is the average investment? Now, the average investment in this case is calculated as the initial investment plus the salvage value. So $260,000 plus $0, which is the salvage value. Whatever the salvage value is, you insert that right there. So the investment at the beginning plus the investment at the end divided by 2. The investment at the beginning plus the investment at the end, all of that divided by 2 gives you the average investment. In this case, $130,000. Okay. So if you do have a salvage value greater than 0, just put in that value in place of the 0. Okay. All right. So that's the average investment. Number 3, we learn what is the formula for the annual rate of return. We need a formula. So here's a good formula for you. It's the estimated annual net income divided by the average investment. So your estimated annual net income or your expected annual net income divided by your average investment. This is the formula for the annual rate of return. And our final answer is going to be in a percentage. It will be a percentage. So we'll go out 2 decimal places in the percentage. Please calculate the answer in number 4 for us. What is the annual rate of return for Potterville's machine? go ahead and calculate that. I'll give you a few moments with that.
Professor, I have a quick question.
Yes.
Where does the 2 come from on question number 2?
It is so the way you calculate an average is you add up all of your elements and divide by the number of elements. So if you think back to just, what you learned about how you find the average of 2 numbers, you add the 2 numbers together and you divide by the 2. If we were trying to find the average of 3 numbers, we would add the 3 numbers together and divide by 3. So I hope that answered the question.
Thank you.
So here, our annual rate of return is calculated as $40,000 divided by $130,000, and we get 30.77%. Okay, 30.77%. And the question is, number 5, should Potterville purchase the machine and why? What do you guys think? Should the company make this?
I'm sorry, 40 divided to 130,000 is $30.77?
Well, it's a percentage.
Oh, 0.3 is 30. Okay, I got it. Thank you. I'm sorry.
So somebody talk to me. Should the company make this investment?
They should.
Why?
Because the percentage is higher than the required.
That is correct. We've calculated a rate of return of 30%, which is higher than the required rate of return of 15%. So that is the answer. Questions, please. Talk to me. Okay.
Could you please repeat the reasoning behind why we should invest?
Yes, we should make the investment because we've calculated an annual rate of return of 30.77%, and that is higher than the required rate of return of 15%.
Thank you.
Okay, so we are back, and I want to take a look at something. Earlier today, I was mentioning how most of our capital budgeting techniques use cash flow and not net income. And when we're presented with net income, we need to make adjustments so that we can convert the net income into a cash flow number. So let's see here. Go with me to workbook page. I want to make this as easy as possible for us. Okay, here's what I want to do. Look at workbook page 490. Workbook page 490. Okay, I'm going to share my screen. I have an Excel screen here for you. All right, so page 490. This is a capital budgeting drill number 6. And it says that a company is considering purchasing a repair machine. The company uses the straight line method of depreciation. The following information was collected. Now, the ultimate question here is, what is the cash payback period for this investment? Now, the cash payback period requires us to use cash flow numbers. And in this particular setup, we're given the initial cost, the useful life, and salvage value of none or zero, but it gives us estimated net income for years 1 through 5, underlying net income there for those years. We need to convert this information, this net income information, into cash flow. So this is what I'm emphasizing, how we convert net income into a cash flow. Now, if you don't already have the net income number, maybe you have revenues and expenses. So the first thing to do is calculate net income, okay, revenues minus expenses. But once you have your net income number, to convert it to a cash flow, you need to calculate what is the depreciation expense included in that net income number, and then you need to add that number back. So I want to cover how do we calculate depreciation expense, and for purposes of our class, we will use the straight line method only. Okay. All right. So in this question, it says on page 490, the company uses the straight line method of depreciation. So let's see if I can make this a little bigger on the screen. So just to bring back to your remembrance, we calculate depreciation expense using the straight line method as it is the cost minus the salvage value. All right. So yeah, cost minus the salvage value. And then all of that divided by the useful life. This is how we calculate depreciation expense using the straight line method. So in this case, our initial cost is going to be $350,000 minus the salvage value of 0. And then all of this is going to be divided by the useful life. In this case, the useful life is 5 years. Okay. So that means our depreciation expense will be $70,000 per year. Okay, so this is depreciation expense. All right, so let me pause there. What questions do you have on how I just calculated depreciation expense? Please talk to me.
Professor?
Yes.
Why do you calculate depreciation for this specific one? Because you did not do for the rest of them in the past.
Okay, so if you look at page 490, the question that you're trying to answer on this page is, what is the cash payback period for the investment? You see that?
Yes.
Okay. In order to calculate the cash payback period, you need to analyze the cash flow. This particular problem does not tell you what the cash flows are. They tell you the estimated net income for each year, but net income and cash flow are not the same. So we need to calculate, we need to convert, I'll say it that way. We need to convert the net income into a cash flow number. The way we do that is by starting with net income and adding back depreciation expense. So I first want to show you how you calculate depreciation expense. So any questions on how we calculate depreciation expense? All right, so everybody's good on calculating depreciation expense. All right, so next we want to convert, so we've got net income, and the years are 1, 2, 3, 4, 5. So we've got 5 years, the net incomes are 153,000, 75,000, 102, 12, 5,000, and 6,000. These are all dollar amounts. All right. And I'm just going to have a column here. I'm going to call it depreciation. And the depreciation is going to be $70,000. And I'll have another column here. I'll call it cash flow. So I'm simply going to add back the depreciation expense to convert the net income number into a cash flow number. Okay. So now, this yellow column here, this is the cash flow column. These are the actual numbers that you're going to use to answer the question on page 490. The only technique that uses net income is the annual rate of return. All the other techniques use cash flow. So if you're presented with net income information, you need to calculate depreciation expense and then add that number back to your net income to calculate cash flow. Okay, so that'll help you with the capital budgeting drill numbers 6 and 7, and just you have to pay attention to it. Okay, sometimes I give you net income, sometimes I give you cash flow. You just need to pay attention to it. All right, so in this area, what I'd like for you to do, let me pause right quick and ask what questions I have here on this concept of converting net income into cash flow. I don't want to take it for granted. What questions do you have?